Why does understanding mortgages matters more than ever for you? You see, the UK mortgage market is evolving rapidly, shaped by interest rate changes, inflation, and lender competition. Whether you're a first-time buyer, an investor, or looking to remortgage, understanding mortgage options and market trends is essential for making informed financial decisions. In this guide, we will break down the most common mortgage types, show you exactly how to calculate your payments, and update you on the latest mortgage news. Now, let's look at the different types of mortgages in the UK. A fixed rate mortgage is a type of loan where the interest rate remains unchanged for a specific period, usually 2, 5, or 10 years. This means that your monthly mortgage payments stay the same throughout the fixed term, providing financial stability and predictability. One of the advantages of a fixed term mortgage is protection from interest rate increases. And number two, easier to budget since monthly payments remain constant. There are several cons. One, if interest rates drop, you won't benefit unless you remortgage. And number two, there's early repayment charges that apply if you want to exit the deal early. We're going to be calculating the fixed rate mortgage as an example. What we're going to do is we're going to take an individual, Ben. Let's say Ben borrowed a principal amount of £200,000 at an annual interest rate of 4% for a term of 25 years. Now, we need to calculate for the monthly mortgage payment. So to do that, there's a formula. M equals P times R bracket 1 plus R bracket N over bracket 1 plus R and minus 1. Now, these different parameters mean different things. We already know that P equals £200,000. The arrow, which is the monthly interest rate, we don't know currently. And to calculate for that, we know that the annual rate is 4%. So that's 4 divided by 12, which is 12 months in a year. We got that percent over there. That should give you 0.3333%. To get rid of that percentage, we have 0.3333 over 100. That should give us 0.003333. So now we need to calculate for N. And N is the total number of payments. Total number of payments in that 25 years. So we already know that there's 12 months in a year. And we know that the term is 25 years. So the answer should be 300 there. So if we put all these parameters, all these figures into the parameters, what we'll have is 200,000 times 0.003333, 1 plus 0.003333. Let's not forget the 300 at the top there. Over, we've got 1 plus 0.003333 and the 300 over there minus 1. So in order to calculate this appropriately, in case you don't know, you will need to calculate what is inside the bracket first to the power of 300. You do the same over here. And when you finish, what you should have approximately would be £1,055 as what the monthly mortgage payments would be. To actually calculate for the total payment over the 25 years, what you now have to do is you multiply 1055 by 300, and that should give you a total of 316. I think that's 500. If I'm not mistaken. That's fine. Correct me if I'm wrong. I think that's 316,500 approximately over the lifespan of the mortgage. So, if you got any questions and there's a part you don't understand, please leave your comments in the comment section and I will address it. Thank you. A tracker mortgage follows the Bank of England base rate with an additional percentage set by the lender. If the base rate rises, so does your interest rate. If it falls, your payments decrease. And here are the pros. 1. It can be cheaper than fixed rate mortgages when interest rates are low. Secondly, no high exit fees in most cases, allowing for flexibility. And here are the cons. Monthly payments can fluctuate, making budgeting harder. And number 2, if interest rate rises, payments can become unaffordable. Now, let's do an example for tracker mortgage, right? Let's now assume that Ben decided to go for a tracker mortgage. So Ben here decided to go for a tracker mortgage for the same principal amount of £200,000. But in a tracker mortgage, there's a base rate set by the Bank of England, and that base rate, let's assume that base rate here, let's take that off. Let's say base rate equals 3.5%. Now, there's a lender's added rate. Lender's added rate, which is usually 1%. So, total annual interest rate will be equal to 3.5.1%, 0.5 plus 1, which is total of 4.5%. Now, we do understand that the annual interest rate is 4.5%. We need to now calculate for the monthly interest rate. So to do that, as we did before in the fixed rate mortgage, we now have 4.5 over 12, have that percent, and if you do that correctly, you would have 0.00375, I think. Yeah, that's right. So that's what you should have approximately. Now, the actual formula for doing this mortgage as well is P times arrow bracket 1 plus arrow to power n over bracket 1 plus arrow raised to power n minus 1. Now, we need to calculate for n, and as we do know, n is the total number of payments equals total number of payments, which is 12 times 25. It's 25 years. So this mortgage is 25 years as well. So that gives us 300. So to do the calculation, we now have M equals 200,000 times 0.00375 bracket 1 plus 0.00375. Let's not forget that 300 over there, very important. And then we have 1 plus 0.00375 375, 300 over there, minus 1. Now, as I always say, if you want to do this type of calculation, ensure to do the brackets first before you do the outer bit, and then multiply by the 0.0375 to get the actual accurate result. So if you do this accurately, what you would come up with is 1,112 approximately. This is what you'll come up with approximately. But we should also note that if the interest rate, or let's say the base rate set by the Bank of England should drop, let's say by 0.5%, right? The amount that Bear would have to pay will drop. However, if there's an increase by 0.5%, the amount that Ben will pay per month will also increase. With an interest-only mortgage, you only pay the interest each month and repay the full loan at the end of the mortgage term. These are commonly used by buy-to-let investors who aim to benefit from rental income and property appreciation, like myself. Here are the pros. Number 1, lower monthly payments compared to repayment mortgages. And number 2, it frees up cash flow for other investments or expenses. So in this example, we're going to calculate the interest-only mortgage. So as before, we will take Ben as the individual. So say Ben, let's say Ben, same time, has borrowed a principal amount. Principal amount equals £200,000. The annual interest rate for this particular example is 4%. Term as usual, let's say 25 years. Now you see that the calculation on this is slightly different from the others. In this, we have to calculate what the annual interest rate is. And annual interest rate will be, in terms of the payment, will be 200,000 times 4%. And if you do that correctly, you would arrive at, I think that is £8,000. I think that is it. Now we need to calculate for the monthly interest rate. And to do that, we will now have to divide this 8,000 by 12 to get the monthly interest rate. And if you divide 8,000 by 12, you should have 666.6. I think it's 0.6666, but let's just keep it at 7 here. So what you will have is, that's a bad looking pound sign, properly, right? So what you will have is £666.67. So, but we do know that the payment is for 25 years. Now, we know that the monthly interest rate is £666.67. And we do know that it's the total number of payments. And usually, because it's 12 times the number of years, which is the term, that should be 300. What we have to do now is multiply, yes, I think it is. We have to multiply 300 times, where is it? Okay, 300 times 666.67. this will give us, I'm just punching my calculator here. If you give me a second. This should give us roughly £200,000. All right, so the total interest payment that Ben will have to pay is £200,000, right? We do know that the principal is equals to 200,000 as well. So the total amount Ben has to pay will be 200,000 plus 200,000, which equals to £400,000. So this is the total amount Ben would have to pay in the life of the mortgage. A standard variable rate mortgage is the default interest rate that lenders apply once a fixed or tracker deal ends. The lender can change the rate at any time, and it does come with some pros. Number one, no early repayment charges, offering for flexibility. Number two, if interest rates drop, your payments could only decrease. And the cons? One, they're usually more expensive than other mortgage types. And two, rates can increase unexpectedly, making payments unpredictable. In this example, we're going to be looking at the standard variable rate. And as usual, we're going to be taking Ben as the person who's taking the mortgage. So the principal Ben is taking here is £200,000. And let's say the standard variable rate is equal to 6%, and the term is equal to 25 years. Now, we need to calculate the monthly interest rate. Yes, we need to do that. So, we need to calculate for R. And to do that, we know the SVR is 6%. So divided by 12, the number of months in a year, of that percent over there. This should give us 0.5%. And if we get rid of this percentage, that should be 0.5 divided by 100. That should give us 0.005. Now, we need to calculate for the number of payments. And to do that, we know that 12 months in a year times the number of years for the mortgage, which is 25. That should give us 300. Now, we need to calculate for the monthly mortgage payment. Monthly mortgage payment. And if you remember, we did have a formula for that initially. That should be P times R bracket 1 plus R bracket, let's support N. That's a terrible looking line. Take that off. We should get a better one. That's better. We have 1 plus R and minus 1. Right? I think that is right. So, keying these figures into these parameters, we have 200,000 times 0.005, 1 plus 0.005. Don't forget to always put that 300 there, remember the N, over 1 plus 0.005, 300 minus 1. Now, if you do this calculation accurately, you should end up with something approximately £1,288. So this should be the amount per month that Ben would have to pay. Now we need to calculate the total amount that needs to be paid over 25 years. Now to do that, we need to multiply 1288 times 300, because the amount of months in 25 years would be 300. So that should give us, just give me a second. That should give us £386,400 approximately. So this is the total amount Ben would have to pay for the life of the mortgage. If you have any questions, you can always leave a comment in the comment section. Now let's look into the current mortgage trends and news in February 2025. The Bank of England has reduced its base rate to 4.5%, its third cut in 6 months. This is welcome news for borrowers, as some lenders have responded by offering mortgage deals under 4% for buyers with large deposits. However, inflation remains a concern. The UK's inflation rate rose to 3% in January, exceeding the bank's 2% target. If inflation persists, the bank may slow further rate cuts, which could impact future mortgage rates. Lenders are adjusting their affordability criteria as the cost of living crisis eases. Some borrowers now qualify for larger loans than they did 6 months ago. However, self-employed individuals still face stricter lending requirements and typically need 2 to 3 years of stable income records. Banks and mortgage lenders are engaged in a rate battle, with high street banks like Santander launching new mortgage products with rates below 4%. This competition is helping to drive down costs for borrowers. The decision depends on if you can secure a good deal now. Waiting might not be necessary. If inflation remains high, rate cuts could slow, making current deals more attractive. And lastly, with banks competing, borrowers might find lower rates sooner rather than later. So here are my final thoughts. The UK mortgage market is constantly shifting. Whether you're a first-time buyer or an experienced investor, staying informed about rate trends and lender policies is crucial. Consulting a mortgage broker can help navigate these changes and secure the best deal. For those ready to buy, now could be the right time. Thank you.